ladies and gentlemen, Asian guy here, and I need you to stop everything you're doing right now. Put down your phone, close the other tabs, because what just happened in the silver market in the last 24 hours isn't just breaking news. It's a declaration of war. It's the moment when the old guard, the paper pushers, the price manipulators, fired their biggest weapon and watched it bounce off the armor of physical reality like a rubber bullet hitting a tank. On Tuesday, January 6, 2026, silver hit an all-time high. Not a 52-week high, not a decade high, an all-time high. The price touched $80.53 per ounce in early Asian trading, shattering every resistance level, every technical barrier, every psychological ceiling that the banking system spent 40 years building. And here's the kicker. Here's the part that should terrify every short seller and every paper trader on the planet, the CME Group, the exchange that controls the futures market, the entity that has successfully killed every silver rally since 1980, just tried to stop this move. They raised margin requirements. They pulled the emergency brake. They deployed the weapon that has worked every single time for the last 45 years. And it failed. Completely, utterly, catastrophically failed. Let me paint you the picture of what just happened. Yesterday morning, as silver was climbing through $78, the CME announced an emergency margin hike. They increased the initial margin requirement for silver futures from $14,000 per contract to $18,500. That's a 32% increase. In normal market conditions, this is the nuclear option. This is the move that forces leveraged speculators to either post more cash or liquidate their positions. It's designed to kill momentum. It's designed to trigger a cascade of selling. It's designed to remind the market who's in charge. But here's what actually happened. The price didn't drop. It didn't even pause. Within 6 hours of the margin hike announcement, silver was trading at $80.12. The market looked at the CME's desperate attempt to regain control and said, "No, not this time. We're done playing your game." Do you understand the significance of this? For decades, margin hikes were the kill switch. In 2011, when silver hit $49, the CME raised margins 5 times in 8 days. The price collapsed from $49 to $32 in a week. The rally was murdered. The speculators were liquidated. The banks won. In 1980, when the Hunt brothers pushed silver to $50, the exchange changed the rules mid-game. They went to liquidation-only trading. They banned new buying. The price crashed 50% in 4 days. The banks won. But today, on January 6, 2026, the script flipped. The margin hike hit the market, and the market absorbed it like a sponge absorbing a drop of water in the ocean. Why? Because this isn't a speculative bubble. This isn't a momentum trade driven by retail gamblers with too much leverage. This is a physical shortage meeting industrial panic in a market where the paper price is completely divorced from reality. The entities buying silver right now, the ones pushing it through $80, aren't hedge funds playing with 10x leverage. They're battery manufacturers in South Korea who need silver to build solid-state EVs. They're solar panel factories in Germany who can't get metal from China anymore. They're sovereign wealth funds who realize that the dollar is dying and they need to own something real. These buyers don't care about margin requirements. They're not trading futures. They're taking delivery. They're buying physical metal. And you can't margin hike physical metal out of existence. This is the moment. This is the inflection point where the paper market loses its authority. For 50 years, the price of silver was set in New York by traders pushing contracts back and forth. Today, the price of silver is being set in Shanghai, in Seoul, in the vaults of industrial giants who are willing to pay any price to secure supply. The CME just learned that they're no longer the referee. They're a spectator watching a game they can no longer control. And if you think $80 is the top, if you think this is the moment to sell and take profits, you're about to make the biggest mistake of your financial life, because what we're witnessing isn't a rally. It's a repricing. It's the market finally, violently, adjusting to a reality that the banks have suppressed for half a century. The reality that silver is rare. The reality that it's essential. The reality that the world is running out of it at the exact moment when the world needs it most. So buckle up, because I'm about to show you exactly why the CME's margin hike failed, why the breakout above $80 is just the beginning, and why the road to $100 and beyond is now mathematically inevitable. The banks just fired their last bullet, and it missed. Let me explain what just happened in terms that will make the gravity of this situation crystal clear, because if you don't understand why this margin hike failed, you won't understand why we're about to witness the most violent repricing event in commodity market history. First, let's talk about what a margin hike actually is. When you trade futures, you don't pay the full value of the contract up front. You put up a fraction, usually 10-15%, as collateral. This is called margin. It allows traders to control massive positions with relatively little cash. One silver futures contract represents 5,000 ounces. At $80, that's $400,000 worth of silver. But you only need to post $18,500 in margin to control it. That's 4.6% of the total value. This leverage is what makes futures markets so powerful and so dangerous. When the CME raises margin requirements, they're essentially saying, if you want to keep your position open, you need to post more cash. Right now, today. For a hedge fund running 100 contracts, a 32% margin hike means they suddenly need to come up with an extra $450,000 in cash. If they don't have it, they're forced to sell. This forced selling creates a cascade. As positions liquidate, the price drops. As the price drops, more traders hit their stop losses. More selling, more panic, the rally dies. This is the playbook. This is how they killed silver in 2011. This is how they killed it in 1980. This is the weapon that has worked every single time for 45 years, until yesterday. So why did it fail this time? The answer is brutally simple. The buyers are different. In 2011, the silver rally was driven by momentum traders and retail speculators. These were people trading on margin, using leverage, chasing the chart. When the margin hike hit, they didn't have the cash to post. They were forced to sell. The rally collapsed. But in 2026, the buying pressure isn't coming from speculators. It's coming from industrial end users who are facing an existential supply crisis. Let me give you a specific example. Samsung is currently building the world's largest solid-state battery factory in South Korea. These batteries require approximately 1 kilogram of silver per vehicle. Samsung has committed to producing batteries for 5 million vehicles per year by 2027. That's 5 million kilograms of silver. That's 160 million ounces per year from one company. Now, Samsung's procurement team looks at the market. They see that China, which used to supply 30% of global refined silver, has locked the gates with export licenses. They see that the COMEX registered inventory is at historic lows. They see that every major dealer is sold out with 6 to 8 week delays. And they realize something terrifying. If they don't secure their silver supply right now, their $15 billion factory becomes a $15 billion paperweight. So what does Samsung do? They don't trade futures. They don't care about margin requirements. They go directly to the physical market. They call the refineries. They call the mining companies. They offer to buy the next 12 months of production at a premium to spot. They're not speculating. They're surviving. And Samsung isn't alone. We're seeing the same panic buying from BYD in China, from Tesla in the US, from solar manufacturers across Europe. These are companies with billions in cash and zero tolerance for supply chain disruption. When the CME raised margins yesterday, these buyers didn't even notice. They're not trading on the COMEX. They're buying physical metal in private transactions at prices that make $80 look cheap. This is why the margin hike failed. You can't margin hike a factory out of needing silver. You can't margin hike geology. You can't margin hike the fact that global mine supply is 830 million ounces per year, and global demand is 1.2 billion ounces. The deficit is real. The shortage is real. And no amount of paper manipulation can change that. But here's where it gets even more interesting. The failure of the margin hike reveals something much darker about the state of the market. It reveals that the CME is no longer in control. For decades, the exchange was the price-setting mechanism. If you wanted to know what silver was worth, you looked at the COMEX screen. But today, the COMEX is increasingly irrelevant. The real price discovery is happening in Shanghai, where silver closed at $85 yesterday. It's happening in private vaults, where industrial buyers are paying $90 for immediate delivery. It's happening in the physical market, where the premium over spot has exploded to $15, $20 per ounce. The paper price and the physical price have divorced. And when that happens, when the futures market loses its connection to the underlying asset, the futures market dies. We saw this with palladium in 2020. We saw this with nickel in 2022 when the London Metal Exchange had to cancel trades and shut down the market. We're watching it happen with silver right now. The CME's margin hike was a desperate attempt to reassert control. It was the exchange saying, "We still matter. We still set the price." But the market's response was a collective shrug. The industrial buyers kept buying. The price kept rising. And the exchange was left standing on the sidelines, watching their authority evaporate in real time. This failure has consequences. It means that the traditional tools of price suppression are broken. It means that the banks who have been shorting silver for decades can no longer rely on the exchange to bail them out. It means that we're entering a phase of pure price discovery where the only thing that matters is physical supply and physical demand. And in that world, in a world where demand exceeds supply by 400 million ounces per year, there's only one direction for the price to go: up, violently, unstoppably up. The margin hike failed because the game has changed. The players have changed, the rules have changed, and the old guard, the paper pushers, the price manipulators, just realized that they're playing a game they can no longer win. The physical market has declared independence from the paper market. And once that happens, once the tail stops wagging the dog, the repricing is inevitable. Now let's talk about what it means that silver broke through $80. Because if you think this is just another number on a chart, just another resistance level that got taken out, you're missing the forest for the trees. $80 isn't a technical level. It's a psychological Rubicon. It's the price point where the entire narrative of the silver market shifts from maybe to definitely. It's the moment when the skeptics run out of excuses and the believers get validated in the most spectacular way possible. For 45 years, the all-time high in silver was $49.45, set in January 1980 during the Hunt Brothers squeeze. For 45 years, every time silver rallied, the bears would point to that number and say, see, it can't break $50, it's a resistance level that will never fall. Silver is a failed investment. That narrative died in December 2025 when we broke through $50. But even then, the skeptics had one more card to play. They said, okay, you broke $50, but that was inflation adjusted. In real terms, 1980's $50 is worth $200 today, so you're still nowhere near the real all-time high. But $80 changes everything. Because at $80, we're not just breaking the nominal high. We're breaking the psychological barrier that kept institutional money on the sidelines. We're breaking the narrative that silver is a volatile, speculative asset that always crashes. We're proving that this time is different. And in markets, once the narrative shifts, once the institutional herd starts moving in one direction, the momentum becomes unstoppable. Let me show you what's happening right now in the institutional world. Pension funds have strict investment mandates. They can't just buy any asset. They need to see sustained price action. They need to see liquidity, and they need to see a clear fundamental thesis. For years, silver failed all three tests. It was too volatile. The market was too small, and the thesis was too conspiracy theory for the suits in the boardroom. But $80 silver changes the conversation. Suddenly, the pension fund manager can walk into the investment committee meeting and say, silver is up 180% in 18 months. It's broken all-time highs. The fundamental thesis is industrial shortage driven by the green energy transition. This isn't speculation. This is a structural supply-demand imbalance. And the committee says, okay, allocate 2% of the portfolio. Now do the math. The largest pension funds in the world manage trillions of dollars. If just the top 100 pension funds allocate 2% to silver, that's tens of billions of dollars of new buying. But here's the problem. There isn't tens of billions of dollars worth of silver available for sale. The entire COMEX registered inventory is worth about $2.4 billion at current prices. The entire annual mining supply is worth about $66 billion. If institutional money tries to enter this market in size, there's simply not enough metal to absorb the demand. This is the setup for a super spike. It's not driven by retail FOMO. It's not driven by Reddit traders. It's driven by the cold, calculated reallocation of institutional capital into an asset class that has been ignored for decades and is now suddenly the most compelling investment on the planet. But the institutional bid is only one part of the story. The other part, the part that makes this breakout truly unstoppable, is the Shanghai premium. Right now, as I'm recording this, silver is trading at 80.53 in New York. But in Shanghai, the front-month futures contract closed at 85.20. That's a 4.67 premium. In a normal, healthy market, this premium shouldn't exist. Arbitrage traders should be buying in New York, shipping the metal to Shanghai, and selling it for a risk-free profit. This arbitrage should close the gap within hours. But the gap isn't closing, it's widening. Why? Because the metal can't be shipped. The logistics chain is broken. The Chinese export licenses have created a one-way valve. Metal can flow into China, but it can't flow out. This means that the Shanghai price is now the real price. It's the price that reflects actual physical scarcity in the world's largest manufacturing economy. The New York price is the fake price. It's the price of a paper contract that may or may not be backed by real metal. And here's the terrifying part. The New York price has to converge with the Shanghai price. It's not a question of if, it's a question of when. The laws of economics demand it. If silver is worth $85 in China, and China is the world's largest consumer, then silver is worth $85 everywhere. The paper market can pretend otherwise for a few days, maybe a few weeks. But eventually, the industrial buyers in the West will realize they're getting a discount. They'll start buying in New York, and the buying pressure will force the price up to match Shanghai. This convergence is the catalyst for the move to $100, because once New York hits 85, Shanghai will be at $90. Once New York hits $90, Shanghai will be at $95. It's a leapfrog effect where each market pulls the other higher, and there's no ceiling, there's no resistance level. Because we're not in a technical trading environment anymore, we're in a price discovery environment where the market is trying to find the level that balances supply and demand. And based on the deficit numbers, based on the industrial panic, that level is somewhere north of $100. But let's talk about the elephant in the room. Let's talk about China's export restrictions, because this is the external shock that has turned a supply squeeze into a supply crisis. On January 1st, 2026, China implemented a new licensing system for silver exports. Any company that wants to export silver from China now needs to meet two requirements. They need to produce at least 80 tons of silver per year, and they need to have a registered capital of at least $30 million. These requirements sound reasonable on paper, but in practice, they're designed to shut down the small and mid-size exporters who used to supply the global market. The result is that China's silver exports, which used to be about 3,000 tons per year, are expected to drop by 70–80%. That's 2,400 tons of silver, or roughly 77 million ounces, that will no longer be available to the rest of the world. Now think about what this means. The global market was already in a deficit of 250 million ounces per year. China's export restrictions just made that deficit 50% worse. We're now looking at a shortfall of 300 plus million ounces per year. That's more than a third of total annual mine supply. This isn't a temporary disruption. This is a structural change in the global supply chain, and the market is only just beginning to price it in. The industrial buyers see this. They see that the metal they used to source from China is no longer available. They see that the Western mines are sold out. They see that the COMEX is empty. And they're panicking. They're not waiting for the price to come down. They're buying at any price because they know that if they wait, there might not be any metal left to buy at any price. This is the new reality. This is the world we're living in post-January 1st, 2026. A world where silver is no longer a commodity. It's a strategic resource. It's a national security issue. It's the bottleneck that determines whether your country can build solar panels, electric vehicles, and 5G networks. And in that world, $80 isn't expensive. $80 is a gift, because the real price, the price that reflects true scarcity, is much, much higher. So where do we go from here? What happens next? And most importantly, how do you position yourself to profit from what's coming without getting shaken out by the volatility? Because make no mistake, the road to $100 and beyond is going to be violent. It's going to be chaotic, and it's going to separate the strong hands from the weak hands in the most brutal way possible. Let me lay out the roadmap. The path to $100 has 3 distinct phases, and we're currently in phase 2. Phase 1 was the accumulation phase. This was 2020–2024, when silver was boring, when it traded between $20–30, when the mainstream media ignored it and the banks suppressed it. This was when the smart money, the industrial giants, and yes, entities like JP Morgan, were quietly accumulating physical metal at discount prices. Phase 1 is over. The metal has been accumulated, the vaults are full, the trap is set. Phase 2 is the breakout phase. This is where we are right now. This is the phase where the price breaks through all the old resistance levels, where the technical traders capitulate, where the narrative shifts from silver is dead to silver is the trade of the decade. Phase 2 is characterized by violent moves higher, failed attempts at suppression like yesterday's margin hike, and growing mainstream media attention. Phase 2 takes us from $80 to $100. And based on the momentum we're seeing, based on the failure of the margin hike, based on the Shanghai premium, I believe Phase 2 will be complete within the next 30–60 days. Phase 3 is the mania phase. This is when silver goes from $100 to $150, $200 or higher. This is when your neighbor starts asking you about silver. This is when CNBC has a silver ticker running 24/7. This is when the pension funds pile in. This is when the government starts talking about strategic reserves and export controls. Phase 3 is where fortunes are made and lost in a matter of days. And Phase 3 doesn't start until we break $100 and hold it. So how do you navigate Phase 2? How do you survive the volatility and position yourself for Phase 3? Here's your action plan. First, understand that the dips are fake. Over the next few weeks, you're going to see days where silver drops $5 or $10. The headlines will scream silver crash. The bears will come out of hibernation and declare victory. Ignore them. These dips are not driven by fundamentals. They're driven by paper manipulation, by stop-loss hunting, by the last desperate attempts of the shorts to shake you out of your position. Every dip is a gift. Every dip is an opportunity to add to your position at a discount to where we're going. How do you know if a dip is real or fake? Watch the premiums. If the spot price drops but the premiums on physical coins and bars stay high or go higher, that's a fake dip. That's the paper price, disconnecting from the physical price. The smart money knows this. They're buying the dip. You should too. Second, focus on physical metal, not paper. I cannot stress this enough. If you're trading silver futures, if you're trading SLV, if you're trading mining stocks, you're playing a different game than the industrial buyers. You're playing the paper game. And the paper game is rigged. The exchange can change the rules. The ETF can suspend redemptions. The mining stock can get nationalized. But if you hold physical silver in your possession, you own an asset that cannot be confiscated, cannot be diluted, and cannot be manipulated away from you. Yes, physical has higher premiums. Yes, it's less liquid. Yes, you have to worry about storage. But in a market that's breaking down, in a market where the paper price is divorcing from the physical price, physical is the only thing that matters. The industrial buyers aren't buying SLV, they're buying bars. You should too. Third, prepare for the $100 breakout. When silver crosses $100, the psychology of the market changes completely. $100 is a round number. It's a headline number. It's the number that gets the attention of every investor on the planet. When we break $100, the FOMO will be intense. The buying pressure will be enormous. And the move from $100 to $120 could happen in a matter of days. But here's the trap. When we hit $100, your brain is going to scream at you to sell. You're going to see your portfolio up 300%, 400%, 500%. You're going to think, this is it, this is the top, I should take profits. And if you sell at $100, you're going to watch in agony as silver goes to $150 without you. So here's my advice. Don't sell at $100. Don't sell at $120. Don't sell until the fundamentals change. And the fundamentals won't change until one of three things happens. Either the deficit gets solved by a massive increase in mine supply, which takes 10 years, or demand gets destroyed by a global recession, which isn't happening while governments are printing money, or the industrial buyers stop panicking and start believing that supply is secure, which won't happen until the China export restrictions are lifted. Until one of those three things happens, every dollar that silver rises is justified by the fundamentals. $100 isn't the top. It's a milestone on the way to the real top, wherever that may be. Fourth, and finally, understand what you're really holding. You're not holding a commodity. You're not holding a speculation. You're holding a monetary metal in the middle of a currency crisis. You're holding the one asset that cannot be printed, cannot be diluted, and cannot be replaced. You're holding the asset that every industrial giant on the planet needs and cannot get enough of. You're holding the asset that JP Morgan spent 15 years accumulating. You're holding the asset that China is hoarding behind export restrictions. In other words, you're holding the winning hand in the greatest game of poker in financial history. The banks are all in. The industrial buyers are all in. The sovereign wealth funds are all in. And you, the retail investor who bought silver when it was boring, when it was hated, when everyone told you it was a waste of money, you're sitting at the table with the giants. So don't fold. Don't get scared out by volatility. Don't sell for paper currency that's being debased to save a banking system that's insolvent. Hold your position. Add on dips. And prepare yourself mentally for the reality that silver at $80 is cheap. Silver at $100 is fair value. And silver at 150 plus is where we're headed once the mania phase kicks in. The CME tried to stop this rally with a margin hike. They failed. The banks tried to suppress this rally with paper shorts. They failed. The skeptics tried to kill this rally with FUD and negativity. They failed. The market has spoken. The breakout is real. The shortage is real. And the repricing is inevitable. You've survived the bear market. You've survived the manipulation. You've survived the boredom. Now comes the fun part. Now comes the part where you get rewarded for your patience, your conviction, and your willingness to hold an asset that the entire financial system tried to convince you was worthless. Silver hit an all-time high on January 6, 2026. The CME's margin hike failed to stop the 80-plus's breakout, and the road to $100 and beyond is now wide open. The only question is, are you going to be on the rocket when it launches into Phase 3? Or are you going to be standing on the ground, watching it disappear into the stratosphere, wishing you had held on? I'm Asian Guy. The breakout is here. The repricing has begun. And the greatest wealth transfer in history is unfolding right before your eyes. Don't miss it. Remember to like, subscribe, and share this video. See you on the other side.